morning. My name is Danielle Kosick, and I'm being joined today by Matt Ringel of DLAK Wealth Advisors. And today we're here to discuss a relevant topic of importance in portfolio management. Matt, welcome.
Thank you. It's great to be joining you today.
Most of our clients are pretty engaged in following stocks, stock styles, and stock sectors through the market volatility of the last few months. But other investment vehicles have tended to get less attention. What are some other important considerations a portfolio manager should be concerned about?
Well, you are absolutely correct that most of our clients' attention has been directed towards stock-related questions. But there are other important aspects of portfolio management that require in-depth knowledge and consistent, focused attention. Although clients are interested and engaged in understanding what opportunities we believe exist in stocks and what excess risk we are looking to avoid, this is much more of a gray area of investment management. As noted in our most recent video, we make our stock selection process as scientific as possible. Almost all do-it-yourself investors underperform, if not drastically underperform the markets, because their emotions get the best of them. What we have chosen to speak to you about today is the easier component of investment management, yet very few, if any, clients are engaged or interested in it: fixed income or bond investing.
With bond yields as low as they have been, why is bond management an important consideration in the management of a portfolio?
With the U.S. Treasury so far spending most of this year yielding less than 1%, it becomes difficult to manage the relatively safe portion of your portfolio. If you want any real return above inflation, you have to do a lot more than buy treasuries and hold them.
What are the components that you use in bond portfolio construction? And could you give us a little look into the process that's being used in running bond portfolios?
Sure. In constructing a bond portfolio, we weigh 4 basic categories of fixed income vehicles and make risk-adjusted decisions as to how to allocate between these components. The first component is fixed or guaranteed bucket. This is the most simplistic concept, where we are searching for guaranteed yields with a stated maturity date. The second component is CDs and government bonds. Not dissimilar to the first component, but these vehicles are generally more liquid. The third component is corporate bonds. At the heart of bond investing is weighing risks versus potential rewards. For almost all of 2020, 10-year Treasury yields have been less than 1%. Yes, less than 1% per year. Successful bond investing over the past 35 years, where you buy treasuries and rates trend in one direction and only one direction, down, has no chance to succeed going forward. To get greater than 1% on your bonds, one will need to understand spreads and when to add risk and when to minimize risk. With corporate bonds of high quality issuers, sometimes you are rewarded or not, with a small increase in yield above treasuries, and at times you may be able to achieve more than 2% more on these types of very high quality bonds. The fourth component is high yield. Of course, it is also important to take advantage of any opportunities to get higher yields from junk bonds, bank loans, emerging market debt, or preferred stocks. With these 4 buckets of fixed income investments, our weightings between them will be dictated by what kind of yield each may represent, and if risks are appropriately rewarded by such. That said, our weightings will vary based upon the interest rate environment at any given point in time. Let's use a recent example of important data that was used in making bond portfolio recommendations. The chart on the left gave us year-to-date changes in spreads and the percentile changes thereof. Take, for example, investment-grade corporates, which ended 2019 in only the 13th percentile spread versus the past 20 years, which represented about 1% yield versus the government bonds. A 13th percentile here tells you that only 13% of the time have corporate bond yields been this low as compared to treasury yields. This suggests there is relatively little opportunity of being rewarded for the added risk of investing in investment-grade corporates when comparing the current spread versus an average spread. Fast forward to April 13th, and this spread grew to the 88th percentile, meaning that in the last 20 years, only 12% of the time would you have anticipated a better opportunity than here, when it offered over a 2% better yield versus government bonds. A second data point example can be seen in the chart on the right. High yield bonds were, at that time, yielding 8.2%, while government bonds yielded less than 1%. If we experience anywhere near historical default rates, you would enjoy returns multiples above what treasuries would offer. In this space, it's about when to hold. Number 2 rule of investing, don't forget rule number 1. Buy high yield when spreads are wide and sell when spreads are tight. If some of this is getting technical for you, hang in there with me. Let's use hypothetical bond investors John and Jane Doe as an example. We would have invested their bond portfolio very differently on December 31st when spreads were tight versus in April when spreads had widened. Say John and Jane Doe's portfolio is worth $2 million and their target allocation is 50% stocks and 50% bonds. They then are targeting about $1 million in their bond portfolio. Using our 4 bond categories, on December 31st, we would have targeted $350,000 in fixed and guaranteed investments, $350,000 in CDs and government bonds, $150,000 in the corporate ladder, and the final $150,000 in high yield bonds. In April, we would shift that target to something more like this: $350,000 in the fixed and guaranteed investments, $150,000 in CDs and government bonds, $200,000 in the corporate ladder, and finally the remaining $300,000 in high yield bonds. Again, the point here is to buy and hold does not work with bond investing, even though bonds represent a safer portion of your allocation. I do not expect you to understand everything we have just covered, but I do ask that you would get with your relationship manager if you have any questions. We are always happy to reiterate the work we are doing on your behalf.
Thank you, Matt, for taking the time today to bring us up to speed on bond portfolio management. And to you, the client, we hope you have found this conversation helpful as we continue our video series to provide education on the work that we are doing for you. From all of us here at DLAK Wealth Advisors, we hope you have a fun and safe summer.